So the term unicorn gets thrown around a lot in tech and venture. It used to mean something really rare, and now it seems like every other startup is claiming that they're soon to be a unicorn or already one. So it's fair to ask, why do VCs care about unicorns? But most importantly, should we still care? So let's dive in, and right before, please consider subscribing to really help me continue publishing great content every week. Thank you. So here's the origin story. The term unicorn was first used by Cowboy Venture co-founder Aileen Lee in 2013. She was trying to define a very specific outcome, a private company, venture-backed, that is still private when it hits $1 billion valuation. And at the time, in the article, there were 39 companies in the US that fit that description. And the point at the time was not really the $1 billion numbers. It was that those companies had escaped the power law curve. They had broken out of the messy middle and became something that on its own could return an entire fund. So a unicorn in the original sense wasn't just about valuation, but it was about a strong signal. It could be a signal of scale, of market dominance, or even of cultural value. It was supposed to be a rare outcome in a business where most bets fail. So let's talk number. A typical VC, let's say they raise $100 million and they're going to invest that in maybe 20 to 30 startups over several years. Now, here's the kicker. As you probably know, most of those investments will fail. We're talking 80 to 90% that will just go to zero and return zero. Nothing, nada. Something like 15-20% will make some money, but not a lot. They might return 2x, 3x, 5x, which is good, but sadly not moving the needle on a $100 million fund. That leaves a very few number of companies, one, maybe two, three, that needs to do the heavy lifting in terms of returns. And by heavy lifting, I mean returning 10x at least, or 50x, 100x, 1000x times the original investment. Let me put this in numbers for you. If a VC invests in a startup $2 million at a $10 million valuation, and then that startup exits at $1 billion, that's 100x return. So those 2 million return 200 million. On its own, this single investment returns this entire fund twice over. That's why VCs don't want steady, just slightly profitable businesses. They need massive outcomes to make their fund math work. And by the way, this is not greed. This is just how the math of your fund works when 80 to 90% of your bets are going to fail and go to zero. Now, this all made sense until everything went completely wild. In 2020 and 2021, interest rates went to zero and everyone was sitting on piles and piles of money with nowhere to put it, and everything got super inflated in the startup world. Picture this: companies that had been around for less than 2 years suddenly were raising rounds at over $1 billion valuation, making them on paper unicorns. We went from seeing a few rare unicorns per year to having new unicorns literally pop out every week. At the peak, there were more than 1,200 unicorns globally, more than had ever been recorded in history before. But here's where it gets crazy. A recent analysis by Index Ventures looked at 400 unicorns, so around a third of all the unicorns in existence, and saw that at least 50% of them should not be unicorns anymore. For example, Bolt, the one-click checkout company, had raised at $11 billion valuation, but announced a share buyback program at $300 million valuation, losing 97% of their value. Klarna, the Swedish buy now pay later company, raised in 2021 at $45 billion valuation, but only a few years later was only valued at $6 billion valuation. Technically still unicorn territory, but an 85% drop in valuation. So let me break down what was actually happening there. During 2020 and 2021, those companies were raising at crazy multiples compared to their revenue, 20 times, 50 times, sometimes 100 times their revenue. So if a company is doing $30 to $50 million in revenue, boom, instantly they're already a unicorn. But of course, when things go back to being reasonable, and if we compare it with today's multiples, similar companies are usually valued maybe 5 times their revenue. And so they started calling those unicorns Zerpicorns, Zerp being zero interest rate policy. Some were even called Bubblecorns, so it is an inflated bubble that's going to pop. I remember reading about some companies that raised hundreds of millions of dollars at unicorn valuation, but they were burning tens of millions of dollars per month with no clear path to profitability. And of course, when the music stops, those companies are in big trouble. Some were growing 200, 400% a year, but losing money all the way with no clear sight of a profitable business. That's not a unicorn. That's an expensive marketing play that's going to end very bad. The reality check came hard and fast. Of the unicorns that have an updated valuation, either through secondaries or a successive round, 30% of them have been dehorned. They're back to being regular companies now, worth less than $1 billion, and industry ventures now calls them horses. It's a unicorn without a horn. It's pretty brutal, but it's actually honest. In fact, over 80% of the unicorns from that era are sitting at valuations lower than their peak, and many of them have lost 70% or more of their original value. But the most telling number might be this. Out of the unicorns created before 2021, only 5% lost their status. But the ones created during the bubble, more than 30% are not unicorns today. So while historically reaching unicorn status meant that you've built something special and unique, actually, if you reach it during that period, it means you probably just had good timing and good storytelling. Now we're finding out which ones actually deserve to be in the unicorn club and which ones were actually just riding the wave. And to stay with the same analogy, Warren Buffett famously said, it's when the tide goes down that we realize who's been swimming naked this whole time. Still, you can't throw out the core idea of a unicorn. Because when you look at companies like Stripe, Airbnb, DoorDash, Dropbox, those valuations and those companies are real. There were unicorns before it was cool. Not because they raised a lot of money, but because they built something meaningful that gets used daily by their users and that brings something new and valuable to the market. Take Stripe. They started in 2010 when online payments were still a nightmare. Patrick and John Collison were not chasing billion-dollar valuation. They were trying to solve a problem that was driving developers crazy. Their solution? 7 lines of code to accept online payments in minutes when it used to take weeks to integrate and to set up. Or Airbnb. They literally started renting an air mattress in San Francisco during a design conference because all of the hotels were booked up. Brian Chesky and Joe Gebbia were not thinking of becoming a unicorn when they were selling Obama-O's and Cap McCain's cereals to keep the company alive. They're just trying to help people make a little bit extra money on the side or find cheap places to stay at. These companies had what we call real pull from the market. People were seeking them out, were repeat customers, and were just spreading the word around. That's fundamentally different than companies that have to spend hundreds of millions of dollars just to get people to try their product. And this is the type of startups that smart money finds early. The best investors go into those deals way before they become obvious. Mark Benioff backed Airbnb when people were still considering that going to sleep at a stranger's house was insane. Sequoia invested in Stripe when it was just still 2 young Irish brothers trying to do better payments. That's the skill that separates the great VC from the rest, seeing the signal when there's no hype around it. So if you want to understand how to systematically create billion-dollar companies, you absolutely have to study Y Combinator. They've basically cracked the code on unicorn production, and they created more than 120 unicorns to date, with very likely many more to come. Of those unicorns that I just mentioned, all of them are actually YC companies. Their track record is honestly ridiculous. So we mentioned Airbnb, Stripe, Dropbox, DoorDash, but there's also Instacart, Brex, Rippling, Deal, OpenAI. The list goes on and on. Unlike most VCs, YC runs what's called an accelerator. It's essentially a unicorn assembly line. Every 6 months when they started, and now every 3 months, they take 1 to 200 entrepreneurs and put them together in a room for 3 months to build as quickly as possible. They give them $500,000, put them through intense mentorship, and just see what happens. It's like running a massive parallel experiment 4 times a year. And of course, most of that 100 plus companies won't make it, and that's okay. YC knows that from the beginning, but they've learned that if you give enough people some money, access to an incredible network, and a pressure cooker of the timeline and the demo day, some of them will go out to create extraordinary big outcomes in big startups. The key insight is both volume and pattern recognition. Because YC has now had more than 5,000 startups go through its accelerator, they've developed key insights to spot trends very early on. They know what the first signs of traction look like. They know what markets are about to explode and what types of founders actually deliver and push through. So if there are real unicorns and fake unicorns, should we still use the term? Well, maybe not. The word unicorn used to mean breakout success. Now sometimes it just means big valuation in a hot market. And some people think we should throw away the term entirely. And maybe they're right. By the way, some of the best unicorn founders that I know hate the term. They think it creates all of the wrong incentives. Of course, you should not optimize for valuation, but for the outcome of your startup. Because once you start optimizing for this, instead of building great products, everything gets distorted. You raise money you don't need just to hit that magical number. You chase vanity metrics instead of real value. You start making decisions based on what looks good on your pitch deck rather than on what's good for your customers. I've talked to founders who've told me they wish they never hit their unicorn status because of all the pressure it puts on them. Suddenly, everyone thinks you're the new Facebook, all of your employees are counting on you to become millionaires, and every investor conversation turns about when you're going to IPO at 100 billion valuation. Maybe we should retire the term entirely and just focus on what matters. Are you building something of real value? Are you making something people want? The real question is, can you build a sustainable business that grows over decades, not just quarters? Now I'd like to hear from you. Tell me what you think of the term unicorn in the comments. Thank you for watching. See you next week.